if we're doing substantial deal volume in the space, private equity firms can't treat us like shit. Otherwise, they're not going to see deals. And so, what we ultimately did is we ended up, I'll give you, even as pest control as an example, it got to the point where we were doing almost 80% of the global volume in the whole industry. No one could do a transaction without us, which protects our clients because the acquirers can't mess with us. And we've finally gotten to that point now in fire protection. So at the end of the day, a buyer can screw with you and push you around. They can't do that with us.
Hi, I'm Paul Giannamore. I wanted to welcome our new subscribers to the channel. Historically, Potomac TV has been focused on business and operational information and interviews for residential and commercial services business owners. But after the publication of the Sell-Side M&A Masterclass last month, my LinkedIn inbox has been inundated with a variety of different requests. So Dylan and I will be sitting down filming more extensive M&A masterclasses, both focusing on the sell side as well as the buy side. I intend to talk about the choice of process, delving deep into M&A psychology, as well as extensive buy side practice, approach, and due diligence. For those of you who have not subscribed, you can click below and subscribe to the channel. Furthermore, we've provided a link here in the description where you can get on our email distribution list. And if you do that, you'll receive an email right in your inbox with our latest publications. Feel free to put a comment below on the types of things you want to see. This channel is largely driven by you, the viewer, and what you want to see from us. Again, thanks for joining us here at Potomac TV.
So I think we're going to turn the microphone around a bit. Paul, you spend a lot of time interviewing other people. You've done a lot of that here. Heck, you even interviewed me yesterday, which was a lot of fun.
Yeah.
But I want to hear a bit about your background, Paul. What Potomac is. We've had folks come up to us here at the fire conference, and they're wondering if we're acquiring companies or what the structure of Potomac is in a sense of your background and what you're here to do.
That's a great question. Thanks, Nick. Look, we're a sell-side advisor, meaning, we do M&A advisory solely on the sell side. So we're always representing sellers. We don't buy companies. We don't represent buyers. And, we have been in the resi and commercial services space for over 2 decades. So we started this business back in the early 2000s. My background, I'm a former tech banker from Credit Suisse, which was back in the tech heyday of the late 90s, if you remember that.
Dot bomb bubble?
Dot bomb bubble, yeah. I worked for a guy named Brick Quattrone, and back in 2003, a partner and I started Potomac, and we focused on resi and commercial services business. So typically route-based businesses like fire protection, for example, pest control, lawn care, anything that basically puts a service technician into a truck and sends it out to a home or a business. And we did that because these industries typically have a handful of publicly traded acquirers that go out and try to buy scale by doing those acquisitions. As well, over the last 15 years, we've seen a tremendous proliferation of private equity money flow into resi and commercial services, and it's been extremely acute in the last 5 years. And that's related to a variety of factors, not the least of which is the fact that yields or interest rates have been extremely low, which actually supports the roll-up model. So at the end of the day, what we focus on is advising sellers. And
so if a private equity firm came to you and said, hey, will you help us buy companies? Do you do that?
They do it every day of the week, and we say, no, we don't do that.
Why not?
Well, our expertise is really on the sell side. I think there's buy-side and sell-side capabilities are very different. Somebody who's experienced selling an asset might not necessarily be so great at buying one and vice versa. When you're selling an asset, you're focused on selling it for the highest price. When you're buying, you're focused on getting it the best deal you can possibly get. So there's a variety of reasons why we don't do buy-side work. One is that's our capability as sell-side. The other one is like, I never want there to be conflicts of interest. I never want to get paid from a large publicly traded strategic acquirer or a private equity firm. I always want to have a fiduciary duty to sellers. And then finally, at the end of the day, our focus is on helping privately held businesses, typically family businesses, face off against large private equity firms and strategic acquirers that have capital and they have a lot of firepower on their side. And so for sport, that's what we like to do.
It's an interesting point you make. So when you think about industries and evolutions of industries, and you think about these smaller, relatively smaller companies vis-a-vis, a big private equity firm, what sorts of capabilities do you bring to these sellers and these firms in order for them to extract the most value as possible?
Historically, the core of our business actually started in facility services. And so when I say facility services, way back in the day when we got started, it was everything, all services that are provided to commercial buildings, for example, commercial cleaning, pest control, hygiene, contracting, so on and so forth. And those industries had experienced rapid consolidation. And I think, over time, as we started to look at fire protection and start to do some of these deals, we've realized that one of the main issues that I think owners in the fire protection space face is it's very rare to meet any of these guys that are doing formal processes. And when I talk about, you asked about capabilities, what do we do? At the core, what we do is run a competitive market process. Whenever you're selling an asset, you've got one asset and you've got a variety of buyers. And you should typically run an auction process to drive up the price. In fire protection, again, we've just recently gotten this in the last few years, but what I'm attempting to do is the same thing in fire protection that we've done in these other industries. For example, in global pest control, we do probably 70% of the transaction value in the entire globe for that particular industry. And there's billions of transactions done per year. And by running formal controlled processes, we've taken transaction multiples from 5 to 6 times EBITDA to 15 to 20 times EBITDA. Now, that's not all our effort. It's gotten extremely competitive.
Take credit for it.
But I will take credit where credit's due. We actually have dramatically changed that market. We've changed the facility services space. And I'm really looking to do that in fire protection. And one of the things that we have done this year is, the fire protection acquisitions were typically at 4 to 6 times trailing EBITDA. The processes that we're running this year with the private equity backed fire protection businesses, we're getting absolute all-time high multiples on these transactions. And look,
great
at the
for
end of the day,
owners.
we piss a lot of the private equity backed platforms off, and I get that, but we're shooting for transaction multiples in the mid-teens is where I want to get fire protection. I want to be doing 12 to 18 times EBITDA deals, whereas a lot of these owners out there are doing 6 and 7 times deals.
Yeah, you look at some of the financial metrics and just business characteristics of the fire protection model, and you could certainly argue that the multiples should be on par with what you're seeing in some of the other commercial and residential services. I'm not so sure, and you tell me, if fire protection owners actually know that this market is emerging for their businesses, meaning this transaction market and the demand that's being created by the private equity firms for their businesses. Do you think the owners are aware?
When I first started eyeing this business, this industry about 5 years ago, it was a relatively sleepy industry from an acquisition perspective. Of course, you had a few private equity-backed platforms that were doing deals, but for the most part, there weren't a lot of exit opportunities for guys. And you would talk to owners and they say, well, listen, I'm just going to run this business, kicks off enough cash, takes care of the family, and then when I'm ready to retire, if I can't sell it, I'll just throw the keys out into the street, the employees can take it.
That's what 2 to 3 times EBITDA multiples will do. Right?
Exactly, right. But now with exit opportunities, I'm seeing the industry, there's a lot of owners now that are actually focused really on growth. They're focused on growing their top line. They're focused on profitability because they know, okay, look, at the end of the day, if I can build a service-based business, there is exit opportunities for me. And we've seen transaction multiples in fire protection increase on the order of 25 to 30% over the last 24 months, which is pretty significant.
Yeah, it's very significant.
I think we're in extremely early innings for this. When I look at, like, for example, the pest control industry, that's in mid to late innings from a consolidation perspective. The green industry, I think HVAC is in relatively late stages. Fire protection, though, is it's approximately a $20 billion U.S. market. It's dominated by small family businesses, typically doing $1 or $2 million per year in EBITDA. And we're in very, very early innings. And so I think there is a lot of potential to put upward pressure on transaction multiples. And I think, one of the things that you and I will talk about today is the competitive auction process and how that actually drives up transaction multiples. But I think that's where we are in this industry now, Nick.
Yeah, I think over time too, one of the aspects of your business that I've seen be very beneficial to owners is not just running that formal sell side process, but also having those more consultative conversations with owners about how they can structure their business in order to receive the highest multiple possible. So I think that's all in front of us here with fire protection as well.
Yeah, I think that's right. I think one of the, you raise a big issue is, typically when we work with our clients, they usually come to us a couple years in advance of a sale. And sometimes not by choice. They come to us and it's just not in a position to be able to sell. And so in the fire protection space, one of the biggest issues that I've come across is just, number one, the books are not particularly great. So I strongly recommend to owners out there, get on track down a company like Fraction, Fraxn. They do bookkeeping and accounting for fire protection businesses. Track down Fraction, get your books cleaned up. What we do is when owners come to us a year or two in advance, we'll do a preliminary evaluation. And basically what we'll do is we'll provide an owner a valuation of where that business would likely sell in the current market, as well as provide somewhat of a roadmap. A lot of times an owner will come to us and say, hey, listen, I need $25 million from my business. We look at it and say, the most you're going to get today is $15 million. Okay, how do we reverse engineer where you want to be versus where you are today and reverse engineer what we need to do? So you're right. That's one of the main things we focus on.
And what we've seen in other circumstances is that having that market-based valuation and assessment year after year after year to really track the valuation and track the metrics and the risk profile that are likely to influence that valuation. It's not only important to get the most value at the end of the day, but it also leads to a better business, less stress on the owner, more profit in the intermediate term. But ultimately, at the end of the day, that is going to lead to a higher valuation that is paid by any type of acquirer, private equity most notably.
On some of the fire protection businesses that we deal with, they're pretty installation heavy. And so they hear what some of their friends have sold for that run very maintenance and service heavy businesses and come to us and say, hey, my friend Jim got X times EBITDA for his business. But he was doing 70% maintenance and service revenue, which is recurring.
Exactly.
And it's a very high margin. Versus you, and you're doing 100% installation. It's not the same business. And so guys that come to us in advance, we're able to look at that and really help guide them on the service mix going forward. So to your point.
And it can really influence the types of capital allocation and growth decisions that those owners are making because they think they're doing great. They hear about their buddy's EBITDA multiple, and all the while they're playing a completely different game with a different risk profile, a different business model, and the resultant multiple ends up being far lower. So it's important to have those conversations early is what I've observed.
Great.
So do you want to get into the sell side process a bit, Paul?
Sure.
Yeah.
Sure. What do you got for me?
So could you maybe, I think it would be helpful so there's proper context and background to really start at the beginning, right? So what is the process when you have an owner, they have a good fire protection business, and they're thinking about selling they're ready. Maybe some life event happened, whatever the case may be. They see an opportunity in the industry. They call Potomac. They, suffer the misfortune of talking to the Mexican right off the bat. But then, eventually they kick off this process with you. What does that look like?
Yeah, I think one of the things that always comes to my mind is I think sellers often think that a business has an objective price, meaning there's a going rate for a particular business, and to a certain degree there is when you think about it from a transaction multiple perspective, but really valuation is extremely subjective, and it's based upon what an acquirer ultimately wants to do. And I think what sellers need to do is if you think about the sell side process fundamentally, at the end of the day, what you're trying to do is take an asset that's scarce. It's the asset that you own. There's only one of these companies with its unique attributes. And you're effectively running an auction. And you have to keep in mind that price is not objective. It's subjective, and you need to get full price discovery. So I think one of the things that, in this particular industry, and fire protection is interesting because a lot of stuff gets done based on relationships. And you might start working with a seller might start talking to a buyer, and a buyer says, hey, listen, we're the best buyer for this business. We'll take care of you. No problem. Da, 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 da. You trust them. That's all great. But at the end of the day, you're doing yourself a disservice as a seller by not doing price discovery. So when you ask, what happens, so when somebody calls us up, one of the first things that we do, we execute a non-disclosure agreement. And that way we know that even the mere fact that we're having this discussion is directly with the client and no one else. No one knows about it. We run a financial model. We take a look at the business. We look at the fundamentals, look at the margins, look at the service breakdown, all the fundamentals of the business, and come up with a range of values, as well as a likely universe of acquirers for the business. Then we sit down with the...
And I would just interject there. I mean, that process, in observing it and talking to owners that have gone through that process, I think even today I heard it being described as meticulous, right? Because if a buyer does not have confidence that the numbers are in good order and that they can rely on them, they're not going to pay up for the business. And so, not to cut you off there, but just to really interject that's a very detailed process that leads to a lot of value down the road.
Well, I mean, to your point, we might jump ahead a little bit, but when you talk about the financials of the business, one of the things that we do is, prior to going out to market, oftentimes we'll do our own cash proof analysis and financial DD on our actual client before taking it out to market because, again, we'll talk about this a little bit later in our discussion. The last thing you want to do is get an offer based upon numbers that are not correct because the buyer is ultimately going to retrade.
That would be terrible.
It'd be terrible, but it happens all the time. But, going back to what I was saying before is, once we put together a financial model, a seller might look at it and say, hey, Paul, I want 15 million for my business, and your valuation says 18 to 20 million. That's exciting. Let's do this. And then typically we would run what's called a modified auction, which is a sealed bid private auction. And how that typically works, Nick, is we would put together sell-side materials, which is basically your financial statements, a variety of data on your business, and then, as opposed to just throwing a bunch of stuff against the wall to see what sticks, we are very thoughtful and deliberate about who the acquirers are that we talk to. So we might talk to 5 or 6 strategic acquirers and maybe 20 private equity firms for a particular business. Once we take a business out to market, running the process requires us to make sure that all of the buyers put together a proposal or a bid, and they're tendered on the same date at the same time, because you always want to be negotiating everything in parallel as opposed to serially.
Right. Yeah, to make it as competitive as possible, and to also bring in the most amount of bidders.
That's right.
It's reasonably feasible.
Yeah, I mean, because at the end of the day, what you're trying to do is you're trying to get a handful of acquirers to bid simultaneously for the ability to buy an asset. And the majority of your leverage as a seller, and my leverage as an M&A advisor, comes from the ability to exert competitive pressure. And really what that comes down to is buyer A, it's at your option now to lose this deal. And so if you're able to put competitive pressure, you can ultimately drive up the price. And we do it through it's an iterative process, which means there's multiple rounds of bidding. So when you think about a sell side process, if bids are due on August 1st, preliminary proposals come in, and then after preliminary proposals come in, you might have 10 bids. Now it's time to jack up the price. So we require the bidders to rebid and so on and so forth, which they absolutely hate. But at the end of the day, ideally, you find yourself in a position where if you're running a competitive process, in some instances, you can double the purchase price of your business.
It's incredible.
I mean, just last week, we're doing a transaction right now where Franco was out on the road, and the platform company that's owned by a private equity firm is doing an add-on acquisition. The owners of the platform business did not run a competitive process. They got an email from a private equity firm that says, hey, we're really interested in your business, da 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 da. They sat down, met with the private equity firm, cut what they thought was a fair deal. Now the platform acquisition is doing an add-on acquisition, and the add-on acquisition is actually at 2x the value of the platform business because the transaction multiple is substantially higher because it is a formal competitive run process. So those are the things that happen.
Wow. Yeah, I've definitely seen some instances over time hearing about initial expectations of valuation versus what actually transpired, and having that competition. That's what leads to those results, not just direct one-on-one negotiation. So
Correct.
So in terms of the process, so once you have the actual buyer, the valuation is done. One thing I always think about when owners are trying to negotiate themselves is thinking about, once the ink is dry, what are the next steps and what that looks like for an owner working with Potomac versus trying to do it on their own. So I would just imagine there's a lot of sophistication involved in actually having an M&A advisor. And I'm sure there's a lot of pitfalls if you try to do it yourself.
Well, I mean, look, I would say that there's a variety of pros and cons to having an M&A advisor, particularly an M&A advisor like Potomac. So number one, we provide sellers and our clients the ability to kind of assess the value of where they are up front so they can plan. We've got the planning phase. From the process phase, we run the competitive process, and we're basically able to tell buyers to piss off, whereas it's very difficult for sellers to do that. We don't have to worry about the relationship per se. So we're able to run the competitive process. In addition to that, in a world dominated by private equity that comes into industries, doesn't necessarily care so much about their reputation because, quite frankly, they might play in 50 or 60 different industries. So they can come in, push sellers around, and then ultimately depart without ramification. With regard to what we do, they can't mess with us. And so in a lot of ways, we almost run a protection racket, if you think about it, because if we're doing substantial deal volume in the space, private equity firms can't treat us like shit, otherwise they're not going to see deals. And so, what we ultimately did is we ended up, I'll give you, even as pest control as an example, it got to the point where we were doing almost 80% of the global volume in the whole industry. No one could do a transaction without us, which
You're the gatekeeper at that point.
which protects our clients because the acquirers can't mess with us. And we've finally gotten to that point now in fire protection. So at the end of the day, a buyer can screw with you and push you around. They can't do that with us. Furthermore, when you think about it from a diligence perspective, I mean, look, we've got a large team. We've got, there's over 40 people on our team now. We've got a due diligence team. We've got an accounting team. We've got an audit team. So, if you're a seller and you're facing off against an acquirer by yourself, you might have an accountant, you might have a lawyer, which you absolutely should, but you won't have all that additional firepower to execute the due diligence process, which, as you know, Nick, is extremely time-consuming. So it's just one of the, I think it's a very, very important capability, and I'm glad you asked about it because I don't really use it as a selling point for us, but you run a transaction with us, we're setting up the data room, we are running all the DD. It really allows our clients to focus on running their business as opposed to running the due diligence process.
Yeah, I think what I've observed over time is a just higher likelihood of deals also falling through during that diligence process when an owner is trying to run it themselves and really trying to protect the owner from over disclosing. Also, I think is an important characteristic of using an advisor versus the buyer asks for something and the owner just hands everything over whether or not they think they should or not.
It's almost comical because it even starts at the NDA phase or the confidentiality phase. I can't tell you how many times I've seen sellers out there that says, hey, I've talked to buyer ABC, for example. I've signed an NDA with them. Why, as a seller, would you be signing an NDA with a buyer? The buyer is supposed to sign the NDA, not you. And even though it might be bilateral, the buyer signed it as well, but you as a seller are not required to sign an NDA. Don't even do it. It's none of their business.
No. And those are the types of nuances, right? When you're doing a deal for the first time and you're doing your only deal, most likely. So one thing I think would be interesting to learn more about, Paul, is transaction multiples. Could you talk a little bit about multiples, particularly multiples that you all are selling businesses for in fire protection versus what maybe businesses are transacting at if the owner is going at it alone and negotiating the deal themselves with a single buyer?
Yeah, I mean, look, the fire protection industry is dominated now by private equity-backed platforms, and they are cash flow buyers, right? And so when we say cash flow buyers, we mean that they are focused on EBITDA or cash flow or any other sort of proxy for cash flow. They're not quote-unquote revenue buyers. And so, Nick, I'll use EBITDA as a proxy for cash flow.
Got it.
And
I won't tell Warren Buffett.
no.
Thank you.
Thank you, madam. And these large platform acquisitions, these things can go.
What's a platform acquisition?
So when we talk about a platform acquisition, we're talking about, these businesses that are platform acquisitions for very large private equity firms, and they may be companies that are doing 100, 200 million in revenue. They've got hundreds of employees. They're kicking off tens of millions of dollars in EBITDA. And these businesses, can go 15 to 20 times EBITDA, these large platforms. And, the investment thesis here is I'm a private equity firm. I buy a large platform business and I might pay 15, 16 times EBITDA for it. But then ultimately I'm able to blend down my entry multiple. So how I make money is, I pay 15 times EBITDA for this platform. Mm-hmm. Then I go out and I find these smaller businesses, we'll call them the family-owned or mom-and-pop business, which might be the $5 million in revenue fire protection business. And if I find that business that does $5 million in revenue and it does $1 million per year in EBITDA, mm-hmm. Can I go out and buy that for $5 or $6 million or 5 or 6 times EBITDA? And that's really where these guys tend to focus. And, last year a client came to us who was referred by another client who had sold, and his fire protection business was doing about $1 million in EBITDA. And he came to us after having gotten offers from a variety of different acquirers. And, he's just running his business. He gets the letters, he gets the emails, he gets the phone calls. All the big players out there are trying to track down sellers. And so.
And these are private equity backed companies?
Almost exclusively.
Almost exclusively.
Yep. There were actually some direct inquiries from private equity firms looking for small platforms, but for the most part, I don't think they realized how small he was. The majority of the inquiries, though, were from private equity-backed platforms that are going out to make acquisitions, and their goal was to go out and buy on the cheap. Mm-hmm. And so, on $1 million in cash flow, he got a variety of offers that are $4, $5, $6, $7 million. At the end of the day, he looked.
How far? Just to interrupt quickly, how far along the line was this owner with these private equity backed companies in terms of, was he close to accepting an offer?
He had signed non-disclosure agreements. He had provided basic information. So what will typically happen is, the seller will get an email, hey, we're interested in your business. He makes the phone call, he sits down, has dinner. the private equity firm or the platform asks for financial information. Hey, give us your P&Ls, let's get some information on the business. We're going to turn around and put together an offer. Now, usually those offers aren't particularly reliable just because the buyer at that point in time doesn't have enough information to really make a concrete offer, but they can be directionally correct. And this guy wasn't particularly far, but he had collected 3 or 4 offers, and he was starting to very seriously consider it. His biggest question was, how do I know if I'm making the right decision or not? I don't do this on a day-to-day basis, and I don't know if I'm being taken advantage of. So one of his friends, a former client of ours, had sold, and he had dinner with him one night, and he said, why don't you call the Potomac guys? So he tracked us down, and we looked at it, and we said, look, we think if you accept any of these, you're probably leaving substantial cash on the table. We put together a financial model, and then he engaged us, and we ran a process. And he's actually in exclusivity right now. His transaction will close soon, and he's going to end up selling for twice that of what the original offers were. So instead of 4 to 6 times EBITDA, his transactions in the 10 to 12 times EBITDA range, which for a business that size is actually fantastic.
And not only that, but just for that amount of wealth, right? Like the difference between 5, 6 million and 12, 13 million. I mean, that's a drastic difference.
Drastic difference.
Right?
Doubled.
Yeah, you can even do a lot more on the tax planning side when you go from let's say mid millions to double digits millions. You can save a lot more on the tax side as well.
So what would you do on the tax side?
So in that situation, what you can do, if you have a transaction that's, in excess of $10 million, which is essentially the level at which we target at Essential Partners, business owners who have a business worth more than $10 million, to then help them cut taxes on that transaction and then manage the wealth after. So what we would do on that transaction is we would most likely, depending on the situation, invest in strategies that target double-digit returns or market-beating returns, but that can also then generate substantial paper losses using tax loss harvesting in order to offset some of the capital gains with those tax losses from the tax loss harvesting.
Let me ask you though, when people say the word tax loss harvesting, they're always quick to say, why would I want to lose money just to save on taxes?
It's a great question. And so I think it's important to just even understand what tax loss harvesting is at the core level, which is, let's say you buy a financial asset for $100, it goes down to $90. So if you sell it at $90, you capture that $10 loss. You can go out then and redeploy that capital into something substantially similar, but not identical. And so now what you have is you have an asset that you purchased at $90, not $100, and then you can let that asset appreciate, okay? So you recognize the tax loss, and then if that asset continues to depreciate, but you don't sell it, and if you don't sell it, you don't have to recognize a gain. So in a lot of ways, a good tax loss harvesting strategy is really a gain deferral strategy as well, because you actually are going to make money over time, but in the intermediate or short term, you're recognizing losses in order to offset the gain on any capital gain, a business sale though, most notably. So in general, that would be part of the strategy.
So how much can you, on a let's make it round numbers here, on a $10 million transaction, by implementing that sort of strategy, how much could you look to save in terms of taxes?
So on a $10 million transaction, if you were to deploy, let's say, $3 million into a tax loss harvesting strategy, and you had nearly a year in order to generate losses to offset the gains, you could expect to reasonably generate 75% of that 3 million in losses in year one. So 75, that's 1.5. It's like we're talking about like $2.25 million in losses, which, if you have a 30% tax rate, that's over $600,000 of tax savings, which is quite substantial given the size of the the taxes in the first place.
And when would you have to implement that strategy? When in regard to the actual transaction?
Well, one of the most effective ways to deploy that strategy is on earnouts or on rolled equity capital gains. So if you were to deploy that strategy a few years prior to receiving an earnout payment where you are going to have and recognize a large capital gain, depending on how much you actually invest in that type of strategy, you could reasonably expect to knock out all of the taxes on an earnout. And effectively what you're doing is you're taking the capital gain on this really concentrated piece of equity, and you're then essentially placing that gain into a diversified portfolio that's targeting, nearly double-digit returns. So it's really a big diversifier and gain deferral strategy related to the tax loss harvesting.
And you can do that over a multi-year period then?
You can. So if you do that a few years in advance, the cumulative gains add up as you continue to generate losses in that portfolio, yet the overall value of the portfolio is expected to increase. It's interesting to hear more about private equity's increasing involvement in fire protection. And, I personally think that oftentimes when I talk to business owners, a lot of people come to me in fire protection and ask me, what is private equity? What are they trying to accomplish? Who are these guys? And so I think it would be important for you and I to really do a segment and dig into private equity, really some of the fundamentals, so folks can understand it more in the fire protection industry.
Let's do it, Nick. On our next session, let's chat private equity.
Sounds good.